Hello everybody, this is AK. I'm back. So in some videos I produced, I said that the pandemic taught me some valuable lessons, and probably the most important one was that as an investor for income, I really want to invest in companies with strong balance sheets, right? Because if the company didn't have a strong balance sheet, then it could have it might have to stop paying dividends or reduce the dividends, or it could even stop operating and just go bust, right? So strong balance sheet is so very important if we want to have a reliable source of passive income in the form of dividends from the businesses that we are invested in. So during the pandemic, what happened was I sold a few of my investments, and one of them was ComfortDelGro. Right, it used to be one of my largest investments, and I sold and used the money to invest in our local banks. All right, OCBC and UOB mostly, and some some DBS, to achieve a kind of balance between all three banks in terms of their allocation in my portfolio, right? So, but I also said that when the price fell to $1.10, $1.15, I went back in and I bought ComfortDelGro shares again. I think it was like $50,000 or $60,000, right? The money that I got from selling my substantial investment in ComfortDelGro wasn't fully deployed in the local banks at the time, and the bank. So because I remember what Peter Lynch taught me, and that's all investments are good investments at the right price. And at $1.10 to $1.15, I thought that ComfortDelGro was too cheap to ignore. So I went back in, I plunked in something like $50,000 or $60,000, and got back in at between $1.10 to $1.15 per share. And I remember saying this during evening with AK and friends last year as well. That was early last year. That I thought it was a pretty good investment, not only because from a valuation perspective, was also because ComfortDelGro continues to have a very strong balance sheet. And I made a video about this, and I'll put a link to in the description box below, about how this company was sitting on $1 billion in cash, its net cash position, and paying out dividends consistently, meaningful dividends consistently, right? So as we come out from COVID-19 pandemic, ComfortDelGro has been increasing its dividend payout to shareholders, and currently the dividend yield is something like 5% dividend yield, right? Which is pretty good from a company that has very strong balance sheet, has a rather robust business, and they're still growing. They're recovering, still recovering well from the pandemic. And if you're wondering, the 5% dividend yield is based on a 60% payout ratio. So they pay out 60% of their earnings, they retain 40%. So similar to the banks, this company ComfortDelGro is growing more valuable over time, right? Because it has retained earnings and is in a net cash position, right? And I did say before that this is probably my favorite transport company to invest in, because I cannot think of a situation where people will stop using ComfortDelGro's services on a day-to-day basis unless we get another pandemic, right? So I did say also that pandemic taught me another lesson, and that's the fragility of these kind of businesses that requires on mass transportation, which of course includes airlines, right? And as SIA was in big trouble during the pandemic, it had to borrow a lot more money, right? Whereas ComfortDelGro didn't have to, because ComfortDelGro was sitting on so much money, and that gave me peace of mind, right? So like I say, ComfortDelGro is still growing, and its Australian subsidiary has been awarded 3 more franchises, right? And with the latest win, we can see that ComfortDelGro has become a leading operator, right? And it serves now currently 20% of Melbourne's public transport, or they call it the metropolitan network, right? So currently, like I say, 5% dividend yield, about 60% dividend payout ratio, and the analysts have eventual 12 months target of $1.66 per share, but take that with a pinch of salt. I'm quite happy that the decision to get back into ComfortDelGro is bearing fruits. If we want 5% dividend yield from a non-bank investment, I think this one is something worth considering, right? Like I said, no matter how confident we are about any business or any sector for that matter, we shouldn't be 100% in that business or that sector, because things could go wrong and we don't know how, we don't know when. It just happens, right? So if if we want a reliable source of passive income, it's not just source, we should have reliable sources of passive income, just to mitigate this kind of risk. Risk of what? Risk of we don't know what we don't know, right? Okay, so if AK can talk to himself, so can you. Bye bye.